Okay, welcome everyone. We'll start our lesson. Today lesson will go through our LO5, learning outcome 5. We had a discussion in last few lessons. We learned about the LO1, LO2, LO3, and last lesson was about LO4. So today really we'll focus about our learning outcome 4, which we'll go through in a minute. And please, if anyone any question, you can ask, so we can go through the things accordingly. Okay, so we'll start. Okay, welcome. Thanks for joining. Good morning, everyone. My name is Anjum Sathar, and it's my email address anjum@university.co.uk. If you have any question, please just drop me email. Today lesson will go through the be able to critically appraise investment options. So we'll look around the investment appraisal. And today lesson key command verb access, reflect, appraise, and justify. And we already discussed about the unit, what we're supposed to be an indicative content. Today really focus will be the managing working capital. What is meant by working capital is mean running capital. Will appraise the investment options, capital, relevant expenditure, risk, and control. Will go through the time value of money. Will go through the project appraisal, and will go through the reflection, inflation. Like, in the simple word, if you have £100 today, is more worth it the £100 you will get in future, because with the passage of time the money's value depreciate. So we have to look around. The value of money is depreciating, so we have to look around. It should be appreciate instead of depreciate. So it's very crucial. We need to be look around. So that will be the key in our lesson. Okay, so in lesson 1 we had a discussion about costing method, which we discuss about ABC. What is the ABC? Activity-based costing. We discuss about absorption costing. We discuss about marginal costing. We discuss about the processing costing. We discuss about financial statement and ratios in the second lesson. Third lesson, we have the budget or the budgetary control and the variance. Fourth lesson, we discuss about the sources of finance, short-term, long-term, medium-term, and the return profit. And fifth lesson today is more about investment appraisal. So please scale 1 to 10. How much you know about investment appraisal? Anyone? Okay, always good to be. When we appraise, we look in 3 areas: in time, in cost, and in quality. Always in normal generic business performance, 360-degree appraisal we use. In financial, we use different appraisal methods. P, which is payback period. So if you invest £100, how long will it take you to cover that £100 what you investing? So that's the payback period. NPV, net present value. If it's a positive, our result will come, we'll accept the project. If your result NPV value is a negative, we reject the project. IAR, higher is accept and lower we reject. ARR is known as the annual accounting rate of return. Higher we accept, lower we reject. Higher is a better. Bank interest. Yes, so we look around the risk factor. We look around the beta. Higher the beta, higher the return we expect. Normally, bank interest is less risky than investing in shares. So that's why we need to be appraise it, which one is the more risky. And so these can be all appraisal methods. 5.1, apply the financial appraisal methods to analyze and competing the investment project in a different kind of organization. The most common objective of the investment appraisal is to maximize the value of the share. Shareholders, we want to be the value of the shares should be go up, and we go through and we look, more in detail. Quite, that's quite crucial. Really, we need to be look around. Okay. Research has found, that to develop the decision-making metrics to maximize the shareholders' value, the following factors need to be incorporated. Cash is preferable to profit. Cash is preferable to profit because we looking in appraisal inflow and outflow of the cash, how much money in and how much money out from the business. That is quite crucial. Really, we need to be look around in and out, inflow or outflow. The second, we need to be look around the exceeding the cost of capital. What is the cost of capital? If you borrow money, what costs you? If you borrow money and you invest it, so your return should be the greater than the cost of borrowing, and it should be greater than the time value of money, so we can be well off. So normally debt is cheaper than equity, and equity is, but you need a balance. If too much debt, it can impact, So a lot of discussion, like Peter Drucker comments Harvard Business School article, until the business return profit that's a greater than the cost of capital is separate at a loss. Never mind that it's pay the taxes, had a genuine profit, and enterprise will return the less to the economy than the in the resources. So until then, does not create, the wealth and destroy it. So you have to be make sure you increase the wealth. So share the stock market place a value on the company's future, the potential, not just, its current profit level. Company announcement about the capital expenditure, research, and new investment are often, treated as a positive rather than the negative factor. We can look around, the announcement may have the determinant effect on the short-term profit. New biotechnology company and example of clearly have the value despite of the fact that the many current have the no product. So we can look around the value of the investment appraisal, time value of money, as we earlier mentioned. If the profit, if your return is greater than the actual real value of money, so due to the following, investment opportunity may be received, could be invested, hence to grow longer. The cost of the finance, the money you borrow, and we look around the alternative, the costing and the return. Inflation factors also reduce the value of money, because if you have 100 now and 100 in future, it will reduce the value. If the future cash flow is less certain, and the implication can be significant, particularly in long-term project, and time value of money, which we mentioned. NPV, net present value, we can look on the marginal internal rate of return, discounted cash flows, all, which we can. And investment appraisal is the business concept, which is we're looking to expected the future cash flow. Anyone, any question here, please? Future cash flow, how much we are expecting to get in future. So we use different technique, like we mentioned, NPV, payback period, and various others. And investment appraisal, can different method allow the potential return on the investment we examine? Yes, so we can look around and different ways which we can calculate these time value of money. So sometime you're buying decisions for various organizations. So we can make internally and contract, our comparison, the relevant cost, different unit variable cost, and any directly attribute to the fixed cost, which we can. The closure of the business segment decision, yes, close the areas of the business, either is a temporary or permanent, and will tends to be based on the short run, the cost, which we can look around instead of the long run. The both cases, qualitative factors must also be taken into account. That's, quite crucial, which we need to be look around. Discounted cash flows. So the basic principle of discounted, if we wish to be have a pound in a year's time, we need to be invest certain sum of the years, and then we look around the percentage we required the some money, like you want to be invest. And when you retired, what money really you expect every month, every week. So you have to be look around the compounding interest. You have to look around the inflation factors, what impact be, so we live well, the life wise. So cost of capital, which we can look around, the discounting terminology, time value of money, net present value, net determined value, net present cost, or the life cost. So we can look around $1 today is worth more than one received at the future time because of its investment potential. The total of PV project inflows minus PV outflows, the value of an investment at the end of the project life cycle, and we can look around the total of PV of the cost and the operation decision that we can look around. So we can look around the outflow. So we have outflow which we invested is the 100,000. We have inflow we getting 20, 40, and 80. So the value of money, if we 10% depreciate, 1 divided by 1 plus R. R is known as the discount factor. And if you carry on dividing, or you look the PV table, it's called present value table, and we can find these figures at 10% off. So that's, which is included. So we can look around here and then you multiply. If we multiply 100,000 with 1, this will be 100,000. If 0.909, if you're getting 20,000 in a year's time, the real value will be 18,180. If you're getting 40,000 in 2 years, this 40,000 value will be 33,040 pound. And if you're getting 80,000 in, because you will see the £1 value is depreciate, so it's 60,000, and if we add them all inflows and minus outflows, so our NPV, net present value, is positive. So we accept the project, otherwise we reject the project. Okay, that's really quite crucial. Payback period is quite useful, which we can look around. Is easy to understand, easy to consider. It's based on the time value of money. And we need to be make sure we consider the payback period. Anyone any question here, guys? Okay, so we can look around the payback period. If anyone need any information, so we can look around the payback period. Payback period is very useful, and then consider the timing of the cash flow, and it's a useful firm operating in the market, have undergo the change. And disadvantage can encourage the short-term thinking rather than the long-term planning, does not consider the profitability of the investment, ignore the revenue. So that's, we have the problem in payback. So let's say we investing 3,100, we getting 1,900, 800. So that's 1,900, 827, 32. And so we have to look around how long it takes our cover to, if we are getting 1,000, 2,100 is remaining. So we are getting 9,000. So inflow and outflow, we invested 3,100, we getting 1,000, 2,100 was outstanding, we getting 9, 12 was outstanding, we getting 8, 4 left outstanding. End of year 3, 4 outstanding, but we got 5 inflows. So 400 divided by 500 times by 12 months in a year. So we can say this project will take 3 years and 10 months. So that's the way we can calculate, guys, and that's quite crucial. We can do the appraisal. If other project will give you 2 years, so you go for the 2 years instead of the 3 years. Okay, then we have NPV, net present value. Good morning, Osama. Are you okay?
Yes, good morning. I'm fine. Thank you. Good morning.
Okay. Yes. So, any questions regarding previous lessons? I'll do a bit recap at the end. Okay.
Okay.
Thank you. Today we are looking NPV. It's called net present value method, and we're looking appraisal method. How we can appraise the pound or the money we have today. The more worth it, the money we'll get in future. So we're looking the net present value of the future cash flow. So consider the time value of money. Take the account of the both timing and the cash. Because if you're investing £100 and you're getting 110 in a, but the inflation is more than 10%, actually you're getting nothing. Actually, you're losing the value of the money because opportunity cost and all. If you have the cash, it's more opportunity. So sometimes this concept is difficult to understand, and you have to look around the choices. So we had a discussion earlier. investment appraisal. So if you investing, let's say you're investing 20,000 and you're getting 5,000, 7,000, and 8,000. So we have to look around the discount factor. So we, in this example, we're looking the discount factor is 10%. So if we do to calculate, it's called PV. PV is the present value of the future cash flow. The money will get in future. So normally the formula 1 divided by 1 plus R. 1 is in £1 today, 1 plus R in the formulas. R is the discount factor. If you think the cost will you, if you borrow money 10%, so you can use the discount factor 10%. So if you do 1 divided by 1 plus, what is 10% means 0.1. So if you do 1 divided by 1.1, your answers will be 0.909. So whatever answers will come, if you carry on dividing 1.1, in year 2 it will be 0.826. If you carry on dividing in year 3, so it means £1 value will be dropped down to 90 pence, 82 pence, and 75 pence in a nutshell. So if we'll say 20,000 you invest, time by 20,000 is cash outflow, the money invested. And if you're getting 5,000, what is the real value of 5,000 is a 4,000 £45. If you look this, if you're getting 7,000 in year 2, because every pound is 82 pence will be left the value, real value. So then is 57. So if you add all these inflows, 4,000, 5,000, 9,000, 6,000, 15,000, and add 1,200 more, yes. So that makes around 16,000. So because you invested 20, the inflow, the real value is less. So you can reject the project. So NPV is a negative. So we reject because the negative value is higher than the positive value, and you reject the project. That's not a good and that's not worthwhile to go ahead and invest in this business. Any question, please? Sama, if you have.
Okay, thank you.
Thank you. So then we have an accounting rate of return. So if we look at the accounting rate of return, it's also known as the average rate of return as well, and is average profit divided by how much initially we invested time by 100. That's the formula we are using, which we'll go through in a minute. So let's say we have 3 projects. We were Handover, Bristol, and Carlisle, the project name. We investing 4 million, 4 million, and this project required 5 million. We are getting 1 million back every year. So in a 5 years, we're getting 5 million back, but we invested 4 million. So there is a 1 million profit, but 1 million it came in 5 years. So 1 million divided by 5, 1 divided by 5 is 0.2. 0.2 divided by 4, initial investment time by 100. So only we getting 5% return. If we look the year 2, we investing 5, but year 1 we are getting 1.5 million, 2.5 million, 5, 5, and 1. So total we are getting 5 million. 5 minus 4 is 1 million profit divided by 5, 0.2 million profit. 0.2 divided by 4 times by 100. So we getting 5% return. So if I'll compare 2 projects, let's assume Handover and the Bristol. So Bristol, even the return is the same, but the Bristol is a better because in an earlier year you're getting more return. The following years you're getting less return. So average rate of return is a 5%. If other industry give me 7%, our bank say deposit the money in the bank, you get 7%. So we'll go 7% because no risk there. So of course we can looking the religious point of view, that can be a separate discussion as well. But so we can look around these here. Carlisle is other project is required 5 million. So if you have 5 million, you can go this project, and first year you not get any profit, second year you get 0.5 million, third year you will get 1.5, 2, 3, and total profit is 2 million. 2 million divided by 5 million. So you will get 0.4 million profit. 0.4 divided by 5 times by 100. So is the 8% profit. So if compared to each project, Carlisle project is a better than all other projects. So in this way, we can calculate which project is a better than other project. So please, that's the way we can calculate ARR and we can look around. Okay, so any project you do, we earlier we discussed about payback period, like you investing 10,000. If you're getting 535, 35, 35, so that make you 9,000 plus 1,500, that make you 10,500. So in 3 years, we getting 10,500. So end of year two is a 7,000 you're getting, but outstanding is uh 3,000. So 3,500 outstanding 3,000 divided by 3,500 you getting. So you can say this project will takes few months. So it will take this project 2 years and few months. So we can exactly the same way here we can look around the average average profit of these projects as well, and then you can decide which project you will go ahead and you can make the decision like our above example. So we need to be look around when we planning the money, express everything, any project you do, express in term of the money. Look at okay, sorry about look around, how much, because we can start the budget and we can make the budget accordingly. Look around the organization objective, where the organization want to see themselves in future. So in the budget, in the budgetary control, we have to look around the money wise budget and the cash inflows and outflows, and that's we can make the budget accordingly. Okay, then we have 5.2. So 5.1 was investment appraisal. So you can discuss one or two methods. I gave example, and when we'll do the assignment discussion, I'll give you sample assignment and we'll go through some examples. So business face, different types of the decision making in the short run and the long run. So you have to look around the financial information, data information, and knowledge is very important. We had a discussion about ratios, financial ratios. We discussed about budget is a financial plan for future. Investment appraisal. So appraisal means appraise in terms of time, cost, and quality, and how quickly you get the return. You appraise all these. Any decision when you're making, you have qualitative and quantitative of information. Quantitative is numbers, and qualitative opinion about the factors you well aware of, political, economic, social, technological, not just the numerical information. So most of the different techniques assist you to decision making. The decision making means selecting the best course of action, best option. Yes, in long term. So in the short run and the long term, we look around like investment appraisal. We discuss about NPV. So what is the NPV, net present value method? So that's if NPV come positive, so you accept the project. If come negative, you reject the project. That's quite crucial if we need to be short-term decision making. We can look around looking and contribution. What is meant by contribution? Contribution is known as selling price minus variable cost. We discuss about the break even, a point where no profit, no loss in, so we can meet the cost of every successive unit. The most common objective of the decision making is maximizing the shareholder value. Anything you do, think about what impact will be on the share value. Research found and developed the decision metrics. Shareholders, we can look around. Cash is a preferable than profit, because if you do the credit sales, maybe you have a profit, but it's based on credit sale, the cash flow, higher correlation to the uh, shareholders. If you do the more cash sales and you have more cash, it increase the share value. Exceeding the cost of capital, your return should be exceed the cost of capital. As we earlier mentioned, the Peter Drucker said, until the business return profit is greater than the cost of capital, it's operate at a loss. Never it's pay the taxes. It's a genuine profit. Enterprise return is less economy than in terms of the wasting of the resources. So it does not create the wealth of the shareholders. So that's really we need to be focused on. The financial information, when we'll say financial, all the numerical information, it help you to make the financial decision. So we discuss about the costing, we discuss about the ratios, we discuss about the credit control, not giving loans to the people those have a poor credit scoring, because it can be a bad debt for the business and it's difficult. So we have to change the payment so our receivable days shorter than the payable days. So that help to increase our profitability. Okay, then we looking information. We need to be from initial transactions, data received from the transaction event is record in accounting. We need to be look around the cash book. Those are known as the prime books, sale day book, purchase day book. So we have all the information. On the basis of this, we prepare trial balance. From the trial balance, we prepare our final account like profit and loss, balance sheet. We had a discussion under the ratios when we discussed. So information need so for business, information need to be, and we need to be look around the various channels. Information is the lifeblood for any business. So we can look around to achieve efficiency, effectiveness. Effectiveness is mean the benchmark, like whatever the standard in the industry. If you're doing more than that, you're doing really good. Internal and external. Internal within the company, external come from outside. You get the all information. So we had a discussion. Data leads to information, and when you have information, what you have knowledge, and you make the decision making, which is named knowledge based decision making. So those we need to be different information system available to provide you the required information. That's we need to be look around. Okay, then we have a 5.3, critically analyze the strategic investment decision using information. Internal control and the risk management are the fundamental component of the good corporate governance. Corporate governance means how the company run and control and manage all the risk. What is meant by risk? Risk is probability or the chance happening. So if it's a high risk, so we expect high return as well. So that's in the business we look at the risk beta or beta factor are known as the risk factor. So financial statement, their own the limited use for, but we need to be look around all like make 1 million profit, but maybe no cash. So that's why we need to be look around the closet to earn, like made the 50 million. There are the closer revival and 60 million. So you have to look around that 50 million is in cash or 60 million in credit sale. Interpret the financial statement and draw the conclusion based on the ratios, based on the external environment. So we had a discussion. So when you're making the decision in the financial term, you can look around all these ratios. You look around risk and return, and you look at the goodwill of the company to whom you're dealing or any project, how long will it take you. The user of the financial statement, of course, there are a number of users. They can make, different decisions. Like a supplier, they can decide either to give the loan to what the credit scoring of the companies or the individual. So we have to look around the management. They can look around the profit levels, and they want to be maintained because their bonus can be linked to. And we can look around the financial institution. They're looking as well. The government is looking the taxes we are paying appropriate, and these are all the financial statement used. Okay, I included the link for you to do the quiz at the end, and that's help you to enhance the understanding of the investment appraisal. So guys, today we discuss about is our investment appraisal. So first method we discuss about payback period. Payback mean how much money you invest, how much money, like we invested 3100. So in 3 years we are covering 3100. At the end of the 3 years 400 was outstanding. So in the year 4 we are getting 500, which is more than 400. So we can't say this project will take 4 years. We can say outstanding amount divided by following year inflow time by 12. So this project will take 3 years and 10 months. So if the other project will take 2 years, so we'll go the lower payback period one, because it's a better we covering the money we investing in it. Okay. Then we discuss about NPV, net present value. Like here we investing 100,000. So we are getting 20,000 year 1, 40 year 2 and 3. We use the time value of money as we earlier mentioned. So we discounted factor. So 1 divided by 1.1. So it comes 0.9. Whatever answers will come, carry on dividing 1.1. Year 2 will be this. Then divide this answer with 1.1 and we'll do is 3. So these are the discount factors. So if we're getting 20,000, the actual value of the money, £1 value will be 90 pence. So 20,000 will be real value is 18,180, 33 and 60. We add all the inflows and minus outflow. Our money we invested, our inflow is the greater than the outflow. So our NPV is the positive. We accept the project. Yes, so this project can be accepted. If our answers come negative, we reject the project. That's the key. So that's all was the investment appraisal method. And we discussed ARR, average rate of return, as we mentioned, Handover and Bristol and other project. Whichever is the return is higher, we'll go ahead with that project. Okay, so that's all from my end. Any question?
Thank you so much.
Thank you. And next lesson will be about assignment discussion.
Okay, thanks so much.
Have a good weekend. Thank you. Bye-bye.
Bye-bye.